Royal Gold RGLD, entering rhythm recovery phase, trap breakdown flow spotted across all timeframes. Hello, this is GeneLog, your trusted rhythm-based market strategist. This report is accompanied by a podcast-style commentary to help beginners understand the flow more easily. For those who prefer reading, the full post is available on the blog. You can also refer to our live broadcasts for real-time index trends to better time your entries. Need faster delivery? Select the priority option. Keycap 1 Summary Royal Gold is showing synchronized signals across all major timeframes. Monthly, weekly, daily, and 120-minute of trap breakdown followed by MACD convergence and rhythm band recovery. This combination strongly suggests a pre-expansion accumulation zone and signals that the next leg up may be forming. A box consolidation is currently in play, offering strategic entry zones. Keycap 2 Investment Opinion 2-week price target. Plus 5.7% right pointing arrow $189.60. Probability 72% 2-month price target. Plus 1.3% right pointing arrow $199.65. Probability 66% long-term price target. Plus 9.4% right pointing arrow $214.10. Probability 58% right pointing arrow entry conditions align with rhythm recovery, MACD convergence, and trap breakdown across multiple timeframes. A strong base for swing to midterm positioning. Bookmark VPAR chart notes from left to right. Monthly, weekly, daily, 120-minute charts key observations. Trap breakdown and subsequent rhythm recovery attempt across all charts. MACD signal line convergence seen on all lower frames. Bollinger Bands indicate compression right pointing arrow. Potential expansion ahead. Price is stabilizing near rhythm support zones. Entry timing window is forming. Keycap 3 VPAR rhythm analysis 120-minute chart right pointing arrow MACD shows tight convergence. Rhythm center line is being reclaimed. Right pointing arrow recent breakdown has stabilized. With a return to rhythm range structure, right pointing arrow expansion may follow if no new lows are set. Daily chart right pointing arrow price consolidating below the swing trend line. Right pointing arrow Bollinger Bands narrowing. MACD ready for reversal. Right pointing arrow box range compression aligning with typical rhythm recovery zones. Weekly chart right pointing arrow pullback from expansion highs. Holding just above rhythm support. Right pointing arrow converging MACD and band compression signal. Possible base formation. Monthly chart right pointing arrow rhythm lines remain in wide band, but price is regaining its footing on the central axis. Right pointing arrow momentum reset appears complete, setting up for next breakout phase. Keycap 4 financial flow quarterly revenue. $193.4 million net profit, $113.5 million net margin, 52.6% quarterly dividend, 45 cents approximately, 1.0% yield, debt-free, strong free cash flow generation. Right pointing arrow a rare mix of consistent profitability, dividend growth, and financial resilience. Keycap 5 news and risk summary. Trump's 2-week deadline on Iran adds geopolitical volatility. However, markets interpreted the move as delayed military action. Easing gold demand concerns. Minor gold price dip driven by short-term profit-taking. Right pointing arrow macro risk still exists but serves as a timing cue more than a trend reversal. Keycap 6 strategy scenario. Checkmark short-term entry zone condition. Trap resolution confirmed plus MACD convergence price range, $176.20 to $179.80 expected consolidation duration, 5 to 9 trading days. Rationale. Confirmed rhythm centerline reclaim on 120 meters chart link target. Possible partial exit at 2-week target of $189.60. Checkmark swing entry zone condition. Rhythm reclaim on weekly chart price range, $170 to $176.20 expected duration, 8 to 14 trading days. Rationale. Support zone overlap with historical rhythm reaction levels. Link target. 2-month target of $199.65 enables swing positioning. Checkmark midterm entry zone condition. Monthly rhythm centerline support confirmed price range. $160 to $168 expected duration. 12 to 20 trading days. Rationale. Historical recovery repeats from same rhythm zone. Linked target. Long-term expansion scenario toward $214.10. Keycap 7 forecast. Royal Gold stock forecast converging MACD plus rhythm recovery equals multi-time frame setup for expansion holding above $176 maintains bullish structure. Upside risk increases beyond $190. Keycap 8 advanced metrics. Institutional flow. 3-week net buying short interest. 2.4% below average. Community sentiment. Rising AI signal model. 71% probability of upward continuation. Checkmark brand disclaimer. This report is generated based on the proprietary VPAR rhythm analysis methodology.
Okay, let's unpack this. Imagine for a moment that the sprawling, often chaotic financial markets aren't just random noise, but that beneath the surface there's a hidden pulse, the discernible rhythm guiding asset prices.
Interesting way to put it.
Today we're taking a deep dive into exactly that concept, focusing on a truly unique approach to understanding stock movements. We're zeroing in on Royal Gold, ticker RGLD, a fascinating company in the precious metal space.
Right. RGLD.
But honestly, this isn't just about one stock. Our real mission here is to explore a proprietary analytical method that claims to identify these underlying market rhythms and, well, It offers some truly surprising insights into what might be coming next for a company like RGLD.
Yeah, this methodology, it's quite something.
Our source material for this deep dive is a detailed market strategy report. It's packed with multi-time frame analysis and this rather fascinating methodology we mentioned.
Very detailed.
And our goal? Well, it's to extract the most important nuggets of knowledge and insight from it, making even these dense market signals clear, compelling, and hopefully actionable for you, our curious listener, as you navigate complex information.
Making sense of the noise, essentially.
Exactly. We want to understand how this VAR rhythm analysis methodology, as they call it, spots opportunities that maybe traditional analysis might miss. What it tells us specifically about RGLD's current trajectory and what it might mean for anyone looking to gain a deeper, almost intuitive understanding of market dynamics. So let's try and tune into the market's hidden beat.
Let's do it.
So right out of the gate, our source material introduces us to something that sounds quite technical. It's called Rhythm Recovery Phase Trap Breakdown Flow for Royal Gold.
Yeah, that's a mouthful.
It really is a mouthful, I know. And it probably feels a bit like trying to read sheet music without knowing the notes.
Fairly daunting at first glance.
But trust me, this is where it gets really interesting because it describes the foundational idea behind what's called the VAR rhythm analysis methodology.
Okay.
In essence, this method doesn't just look at, standard price charts. It actively searches for these underlying, almost biological rhythms in how the market behaves.
Like a heartbeat.
Exactly. It's like trying to find the unique heartbeat, the consistent cadence of a stock amidst all the daily fluctuations and noise.
It's a powerful concept because at its core, what's fascinating here is how the report synthesizes multiple sort of disparate signals across various time frames. It's almost like conducting an orchestra.
An orchestra. I like that analogy.
Yeah, it's not just looking at one chart in isolation, Instead, it's seeing a synchronized symphony of data signals on monthly, weekly, daily, and even the very granular 120-minute charts for Royal Gold.
Wow, all of them.
All converging and pointing towards a specific high-probability pattern. This multi-time frame alignment, that's really what gives the analysis its predictive power.
Okay, so it's the combination that matters.
Precisely. Now, to truly appreciate the symphony, let's break down some of the core terms the report uses, because they're fundamental to understanding this methodology.
Good idea. Let's get into that jargon.
Okay, first up is trap breakdown. Think of the market as like a bustling bazaar. Sometimes a seller might cleverly drop something, making it look like a bigger mess than it is, maybe luring buyers in, only for the price to suddenly move in the opposite direction. In market analysis, a trap is essentially a deceptive move, a false signal that lures a large number of traders, often those chasing what looks like a clear trend, into taking the wrong side of a trade.
So they get caught.
They get trapped in a losing position, exactly. Now, when a trap breakdown occurs, it means that this false deceptive move has definitively failed. The price then reverses sharply, often with significant momentum, moving against the direction of the original trap. This is crucial because it signifies that the market has effectively shaken out the weaker hands, those who fell for the initial deceptive signal. It sort of clears the path, if you will, for the genuine underlying trend to emerge with renewed force.
So it acts as a precursor.
A powerful precursor to a new, often sustained move. It's the market basically saying, psych, that wasn't the real direction.
Right, clearing out the noise. Makes sense.
Then we have MACD convergence. MACD stands for Moving Average Convergence Divergence. It's one of the most widely used momentum indicators in technical analysis.
Yeah, I've heard of MACD.
Right. At a basic level, MACD visually shows you the relationship between two moving averages of a stock's price. It's often represented by two lines and a histogram. Think of it like this. If you're driving a car, MACD doesn't just tell you your current speed. It tells you if you're accelerating or decelerating, and maybe if you're about to change gears. When the MACD lines are converging, it means they are drawing closer together.
Okay, coming together.
Exactly. This often signals that the momentum in the current trend is starting to weaken, and a change in direction or a potential reversal is on the horizon. It's like a spring coiling tighter and tighter, building up potential energy just before it unleashes a new push in a different direction.
So it's a warning sign, potentially.
A key signal that a shift might be imminent, yeah.
Okay.
And finally, central to this unique proprietary method is rhythm band recovery. Imagine a stock, much like a dancer, has a natural, inherent rhythm to its movement.
Rhythm.
The rhythm band is a key component of the VAR rhythm analysis that identifies this established channel or cycle within which a stock's price typically moves, like a natural sine wave.
Like boundaries.
Sort of, yeah. When the price deviates from this band, maybe it swings too far up or too far down, it's considered an anomaly, a temporary imbalance. So its recovery indicates that the stock is stabilizing and snapping back.
Snapping back, right.
Returning within its expected natural cyclical pattern after such a deviation. It's very much like a pendulum that swung too wide, maybe pushed by some fleeting external force, but is now finding its way back to its natural oscillation, its equilibrium point.
Okay, finding its balance.
This rhythm band recovery suggests a return to a more stable, predictable movement within its inherent market rhythm. And critically, it often precedes a renewed significant move in the direction of that rhythm. It's the stock finding its balance and getting ready to move with purpose.
Got it. So trap breakdown clears the noise, MED convergence signals a change, and rhythm band recovery means it's back on its natural path.
You nailed it. This powerful combination, the trap breakdown, the MACD convergence, and the rhythm band recovery, strongly suggests what the report calls a pre-expansion accumulation zone.
Pre-expansion accumulation zone. Okay.
This isn't just random market noise or some coincidence. It's a specific and identifiable pattern that indicates a quiet but significant buildup of buying interest, often by more informed investors, before a significant upward move.
Like the calm before the storm.
Exactly, but a bullish storm. A period where smart money might be quietly accumulating shares because they see the underlying rhythm aligning for an upward expansion. The report highlights a box consolidation currently in play, offering strategic entry zones.
Ah, the box consolidation. That sounds important for timing.
Absolutely crucial for anyone considering Royal Gold or, applying this method to any stock. It means the price is currently moving sideways within a defined, relatively tight range. And for this analysis, that very consolidation presents a calculated window,
A window of opportunity.
a strategic entry point before the anticipated next leg up. It's the stock pausing to gather strength, a critical moment for strategic positioning.
That's a fantastic breakdown. Really paints a clear picture of how these technical elements aren't just isolated data points, but are telling a cohesive story.
Right, they connect.
So what does all this mean for us, the listeners, when we look at Royal Gold? It means there's a strong, technically driven picture being painted here. It's not just a hunch or some speculative guess. It's a methodical identification of very specific, reinforcing market behaviors.
Based on their methodology, yes.
But a stock's rhythm isn't just one note, is it? Like you said, it's an orchestra. How do these intricate signals look across these different time frames, from the very long-term monthly view down to the daily, weekly, and even that very short-term 120-minute chart? How does this symphony truly play out across these varying durations?
You're absolutely right. A true rhythm isn't just a single beat, but a recurring pattern across different speeds, different tempos.
Okay.
So if we connect this to the bigger picture, the report gives us a remarkably detailed look at how these signals manifest and synchronize across different durations. This multi-timeframe approach is fundamental to the VAR rhythm analysis methodology
Why is that so fundamental?
because it allows us to both pinpoint precise, immediate timing opportunities and simultaneously maintain a comprehensive understanding of the overarching long-term trend. It's like having different lenses with a microscope for the short-term action and a telescope for the grand trajectory.
Microscope and telescope. Got it.
Yeah.
So where do we start? Short term.
Let's start with the most immediate pulse, the 120-minute chart insights. Here, the report notes that MACD shows tight convergence. On such a granular time frame, this isn't just a casual observation, it's a powerful signal suggesting a very immediate and intense buildup of momentum.
Like that coiled spring you mentioned.
Exactly. Think of it as a tightly coiled spring ready to release its energy.
Right.
This indicates that buying and selling pressures are reaching a critical point of balance, primed for a decisive breakout move very soon.
Okay, very soon.
Simultaneously, the rhythm center line is being reclaimed. This is a swift sign of short-term stability within the stock's established rhythm, almost like a rubber band snapping back to its original shape after being stretched.
Back to normal, quickly.
It indicates that any recent short-lived deviations have been corrected, and the price is quickly snapping back to its natural expected short-term path. Furthermore, the report says the recent breakdown has stabilized with a return to rhythm range structure.
Meaning the dip was temporary.
Clearly tells us that any recent dip or downturn was temporary and corrective, not indicative of a larger problem, and the price has rebounded back into its expected operational range. This raises an important question for immediate action. If no new lows are set from this point,
Uh-huh.
then expansion may follow. This gives us a very clear, actionable, short-term condition to watch, a critical indicator for imminent price action for those looking for rapid opportunities.
Okay, so watch for it holding that recent low on the short-term chart.
Precisely. Now let's zoom out a bit to the daily chart observations. This offers a broader perspective, but with reinforcing signals that add weight to the short-term view.
So daily should confirm the 120-minute.
Ideally, yes, and add more context. The report notes price consolidating below the swing trend line. This indicates a pause in the immediate upward movement, a moment where the market is catching its breath after a prior surge.
A pause. Okay. Is that bad?
Not necessarily. Quite the opposite, potentially. Crucially, the report mentions Bollinger Bands narrowing. This suggests that volatility is decreasing significantly.
Bollinger Bands. Remind me.
They essentially measure a stock's price range around a moving average. Think of them as volatility bands. When these bands squeeze together or narrow, it's like that spring being compressed again. It often precedes a sharp, decisive move in either direction once the pressure is released.
So low volatility now means high volatility soon.
Often, yes. The narrowing here indicates an impending surge in volatility, often leading to a directional breakout. And the report says the MACD is ready for reversal on the daily too, which strongly reinforces the idea of an impending shift in momentum from this consolidation phase, confirming the coiling action we saw on the 120-minute.
Okay, so multiple signs pointing to a potential move soon.
And what's particularly significant here is that this box range compression is aligning with typical rhythm recovery zones. This tells us that this period of consolidation isn't random. It's happening precisely in an area where the rhythm analysis methodology predicts and expects recovery to occur.
So it's consolidating where it's supposed to.
Exactly, making it a high probability zone for a bounce and a strong foundation for the next upward leg, according to this analysis.
Interesting. What about the weekly chart? Even broader view.
Stepping back even further, yes, the weekly chart perspectives offer an even broader view, truly indicating the strength of the underlying trend and offering greater conviction.
Okay, conviction. I like that.
The report highlights a pullback from expansion highs holding just above rhythm support. This is vital. It suggests that while the price has retraced from its recent peaks, which is a healthy market correction, by the way,
Right. Stocks don't go straight up.
the larger trend is still decisively upward. The pullback is merely a natural ebb to a key support level identified by the rhythm analysis, rather than a reversal of the overall bullish trend. It's like the stock touching down to refuel before its next descent.
Refueling, okay.
And here we again see a converging Mansi-D and band compression signal. But the fact that this confluence of signals appears on a weekly time frame points to a much more robust and longer-lasting possible base formation.
A base on the weekly chart. That sounds significant.
It implies significant accumulation over a longer period, acting as a very strong foundation for a sustained upward move rather than just a fleeting bounce. It signals deep underlying strength.
Wow. Okay, so short term, daily, weekly, they all seem to be lining up. What about the really big picture, the monthly?
And finally, yes, let's look at the monthly chart, the big picture. This chart provides the macro view of Royal Gold's rhythm, the grand sweep of its movement over years.
The long game.
Exactly. It shows that rhythm lines remain in wideband, but price is regaining its footing on the central axes. This indicates the stock is well within its long-term established rhythm, comfortably operating within its natural cyclical boundaries. Any recent dips have merely been a return to the center of that long-term trend, a return to equilibrium after a wider swing.
So even the dips are part of the long-term rhythm.
According to this analysis, yes. The core insight here is truly profound. A momentum reset appears complete, setting up for next breakout phase.
Momentum reset.
Think of it like a massive pendulum. It swings wide, maybe reaches an extreme in one direction, but eventually settles back towards the center or its equilibrium point before gathering momentum and swinging strongly in a new, often opposite direction.
Okay.
The monthly chart shows this comprehensive resetting of the pendulum for Royal Gold, positioning it for its next significant, sustained, long-term upward swing. It's the ultimate confirmation in this view that the longer-term forces are aligning.
Wow, that truly is a symphony. You weren't kidding. This comprehensive, multi-time frame analysis is what really makes this deep dive unique, helping us understand the granular, immediate details while always keeping the bigger overarching picture clearly in view.
It's about seeing the forest and the trees.
Exactly. It's like watching a high-resolution film of the market in slow motion. The report also references VPR chart notes. You mentioned those earlier. It's fascinating how they reinforce these observations so beautifully.
Yeah, the VPR notes summarize it well.
They highlight the universal presence of trap breakdown and subsequent rhythm recovery attempts across all charts. So that pattern, shaking out the weak hands, returning to the path, isn't isolated. It's a recurring theme everywhere.
Across all time scales they looked at, yes.
We also see MACD signal line convergence, specifically on the lower frames, like the 120-minute, confirming that immediate momentum is indeed building, that spring is coiling tight.
Right, the immediate trigger.
The Bollinger Bands indicate compression, signaling that a period of high volatility and potential expansion is ahead, just as you described.
That squeeze.
The calm before the potential storm.
And crucially, the report notes that price is stabilizing near rhythm support zones, which strongly signals that a well-defined entry timing window is forming for those looking to position themselves strategically.
That's the actionable part, the where and when.
Okay, so we've thoroughly explored the technical rhythm. We understand how this multi-timeframe analysis paints a compelling picture of royal gold, almost predicting its dance moves, you could say. Now, this isn't just about recognizing patterns for pattern's sake. Let's talk about what all this means for potential investment strategies, according to the report's clear investment opinion and its strategic playbook. This is where the theoretical analysis truly gets practical, offering actionable insights for you, the listener. Absolutely. This raises an important question. What are the potential upside scenarios this sophisticated analysis points to? And maybe more importantly, how confident is the methodology in predicting those outcomes? Because that's where the rubber meets the road, isn't it?
Exactly. Targets and probabilities.
The report provides clear, tiered price targets, and crucially, it assigns associated probabilities to each. This is incredibly useful for understanding the conviction behind the forecast, giving you a sense of both potential reward and the likelihood of achieving it. It doesn't just give you a number, it gives you a calculated probability.
Okay, so what are these targets?
All right, for the immediate term, there's a 2-week price target of $189.60 with a very high 72% probability.
72%. That's quite high conviction for 2 weeks out.
It indicates a strong, high conviction immediate signal, suggesting a high likelihood of royal gold reaching this level quickly based on the short-term rhythm recovery and mass CD convergence we discussed.
Okay. What about further out?
Looking a bit further out, the 2-month price target is $199.65 with a 66% probability.
Still high, but a bit lower probability. Makes sense.
While still quite high, the slightly decreased probability naturally reflects the inherent uncertainty that increases with the longer time horizon. The further out you try to predict, the more variables can intervene.
Sure, more things can happen in 2 months.
Exactly. And for the long-term price target, it's $214.10 with a 58% probability.
58%. Okay. Still better than a coin toss, but acknowledging more uncertainty.
This tiered approach allows you, the listener, to consider different time horizons for your interest. Whether you're looking for a relatively quick swing trade or a more sustained, longer-term position, the higher probabilities for shorter terms suggest a stronger immediate signal and more confidence in the initial move. While the decreasing probability for longer terms is simply a realistic acknowledgement of inherent market unpredictability over extended periods.
Got it. So probabilities help gauge the confidence at different time scales. What about getting in? Does it talk about entry points?
Oh, yes. The report is very explicit about the precise entry conditions it identifies. It states that entry conditions align with rhythm recovery, MCD convergence, and trap breakdown across multiple timeframes.
The whole trifecta we discussed.
Exactly. It's not just one signal flashing green, it's the powerful confluence of all these critical technical indicators, precisely synchronized across various charts. This alignment, the report argues, forms a strong base for swing to midterm positioning.
Swing to midterm, meaning not just a quick flip.
Right. This means it's not just an opportunity for a quick scalp or an intraday trade. Instead, this analysis suggests a compelling opportunity with the potential for a sustained, meaningful price move over weeks to months, rather than just hours or days.
So it has legs, potentially.
That's the idea. It's about getting in during this identified accumulation zone, when the smart money might be quietly building positions just before the expected expansion phase truly kicks in. It's about catching the wave early.
Fascinating. So this isn't just theory or vague predictions. The report gives us concrete strategy scenarios, a veritable playbook, as you called it. It outlines specific, actionable entry zones, each complete with precise conditions, target price ranges, and even expected durations for the consolidation before the anticipated move. Let's look at how someone might actually use this in a real-world scenario to make decisions. It's about transforming analysis into action.
Precisely. The report meticulously outlines 3 distinct entry zones. Each one is thoughtfully tailored to a different time horizon and risk tolerance. This provides a practical, adaptable roadmap for potential engagement based directly on the deep insights from the VAR rhythm analysis.
Like different paths up the mountain?
Kind of, yeah, like choosing the right gear for the terrain you're about to tackle.
Okay, what's the first zone?
First, we have the short-term entry zone. This is designed for those who are looking for a relatively quick move, perhaps capitalizing on an immediate bounce, and who are comfortable relying heavily on very immediate technical signals.
For the nimble trader.
You could say that. The primary condition for this entry is trap resolution confirmed plus MAC-E convergence. This means that initial deceptive false move has been definitively negated and reversed, and short-term momentum via MAC-D is clearly building.
Okay.
The recommended price range for this entry is quite tight, $176 and $279.80.
Very specific range.
And the expected consolidation duration within this specific zone is remarkably short, 5 to 9 trading days, indicating an anticipated rapid resolution.
Quick turnaround expected.
The rationale behind this precise timing is a confirmed rhythm centerline reclaim on the 120-minute chart, that very immediate and strong signal we talked about, the stock snapping back into its short-term rhythm.
Right, the 120-minute signal.
And the report suggests a possible partial exit at the 2-week target of $189.06, indicating a short-term profit-taking opportunity. So this entry is ideal for an agile trader who is watching the market closely and wants to capitalize on a rapid, technically driven bounce, aiming for a swift return.
Okay, clear. What's the next zone? A bit longer term.
Next, we move to the swing entry zone. This offers a bit more room for the move to develop and leverages a stronger, more robust weekly signal. It's for those seeking a medium-term play rather than just a quick scalp.
Okay, holding for maybe weeks instead of days.
Potentially. The condition here is rhythm reclaim on the weekly chart. This signifies a more substantial and confirmed return of the stock to its broader cyclical pattern after a deviation, providing higher conviction than just the 120-minute signal.
Based on that stronger weekly chart signal.
Exactly. The suggested price range is slightly lower and broader, $170 to $176.20. This allows for a potentially deeper entry during a minor pullback within the broader trend.
A wider net, potentially better entry price.
Possibly. The expected duration for the move to play out from this entry is 8 to 14 trading days, indicating a sustained move is anticipated. The compelling rationale here is a support zone overlap with historical rhythm reaction levels, meaning this specific price area has a historical track record within the VAR rhythm framework of seeing strong buying interest and subsequent recovery. History repeating itself, potentially.
Ah, so it bounced from here before in a similar setup.
That's the suggestion. The linked target is the 2-month target of $199.65, which the report says enables swing positioning. This suggests that this entry provides a solid, more patient foundation for capturing a significant medium-term swing higher, building on the weekly rhythm confirmation.
Makes sense. And the third zone, the longest term one.
Finally, for those with a longer time horizon, maybe a higher conviction, and perhaps more patience, there's the midterm entry zone. This strategy is deeply grounded in the strongest, longest-term rhythm signals identified in the entire analysis.
Based on the monthly chart.
Primarily, yes. The condition for this entry is monthly rhythm center line support confirmed. This is a powerful macro signal that the stock is confirming its long-term cyclical bottom and is truly ready for a sustained multi-month expansion, according to the analysis.
Okay, the big picture confirmation.
Right. The price range for this entry is the lowest and broadest, $160 to $168, presumably catching it during a more significant but still healthy consolidation within the overall rhythm.
So buying a bigger dip, potentially.
If it gets there, yes. The expected duration for the move to materialize from this entry is 12 to 20 trading days, indicating a longer holding period to capture the full scope of the rhythm's expansion.
And the rationale.
The rationale is highly compelling. Historical recovery repeats from the same rhythm zone, meaning the VAR rhythm methodology has observed this exact pattern leading to powerful, sustained upward moves on prior occasions from this very area.
Wow, so it's a repeating long-term pattern.
That's the claim. The linked target is the long-term expansion scenario toward $214.10, indicating that this entry is strategically positioned for the most substantial upside potential identified by the analysis, allowing for patient investors to capture the maximum benefit from the stock's inherent rhythm.
That's incredibly detailed and frankly quite empowering to see how granular this analysis can get in terms of actual strategy. You've got short, medium, long-term options let out.
A full playbook, as you said.
Now, it's easy to get lost in the technical charts, right? The squiggly lines, the complex indicators. But for a company like Royal Gold, which operates in the real economy, the report also gives us crucial context beyond just the technicals. Its fundamental financial health and the broader news environment.
That's critical context.
So what does this all mean for RGLD? Beyond the rhythm, does the company itself have the underlying strength to support this bullish technical outlook? Or is it just, a beautiful but fragile pattern on a chart?
That's an excellent point, and it really raises an important question. Is this just a speculative technical play, or does the underlying company possess the fundamental strength to truly support the technical outlook? This is where the report adds a crucial layer of validation.
The fundamentals.
Exactly. The financial data it provides paints a very robust picture, adding a strong fundamental underpinning to the technical rhythm recovery we've been discussing. It's about ensuring the company's financial heartbeat is strong and steady.
Okay, let's hear it. How strong is it?
Let's delve into the key financial metrics detailed in the report because they are genuinely impressive, especially for a company in the mining and resource sector or related to it.
Okay.
Royal Gold's quarterly revenue stands at $193.4 million. Out of that, they reported a remarkable net profit of $113.5 million.
Wow, over half the revenue is profit.
Now, what truly stands out here is that this translates to an astonishing net margin of 52.6%.
52.6%, that's huge.
To give you some context, achieving profit margins above 50% is incredibly rare across most industries, let alone in resource extraction, where costs can be highly variable. This figure indicates exceptional cost control, highly efficient operations, and a very lucrative business model.
How do they do that? Isn't mining expensive?
While unlike traditional miners who bear all the operational costs and risks, Royal Gold operates primarily on a streaming and royalty model.
Ah, the royalty model, right.
This means they provide upfront financing to mining companies in exchange for the right to purchase a percentage of future production at a fixed low cost or receive a percentage of the revenue from their mines. This model significantly de-risks their business compared to operating miners, provides those high margins, and generates very predictable cash flows.
Less risk, high margins.
Yeah.
Sounds like a good model.
It can be very effective. Beyond profitability, the company also pays a consistent quarterly dividend of 45 cents, approximately a 1.0% yield. In today's market, a consistent dividend from a financially sound company that also shows strong growth is a significant positive for investors seeking both capital appreciation and income.
Dividend plus growth potential. Nice combo.
And perhaps most importantly for long-term stability and resilience, the report notes that Royal Gold is debt-free.
Debt-free? Seriously?
Right.
In this sector?
It's an exceptionally rare and highly desirable financial position for any company, especially one tied to commodity cycles. It eliminates a major source of financial risk that many companies face, providing immense flexibility.
Huge advantage.
Coupled with this, they demonstrate strong free cash flow generation, meaning they consistently generate significantly more cash than they need to run their operations and pay dividends. This surplus cash can then be used for more dividends, share buybacks, or future growth opportunities without having to borrow.
So they're making money hand over fist and have no debt.
Pretty much sums it up. The report explicitly states that this is a rare mix of consistent profitability, dividend growth, and financial resilience. This financial strength truly provides a solid, almost unshakable fundamental underpinning for the technical rhythm recovery we've been discussing.
Okay, that definitely adds weight.
It suggests that the technical patterns identified by the VAR rhythm analysis aren't just wishful thinking. They are powerfully supported by a fundamentally sound, well-managed business that has the financial muscle to not only weather potential storms, but also to execute on its growth potential. It's the sturdy ground beneath the dancing feet, so to speak.
The sturdy ground beneath the dancing feet. I like that. That's a powerful validation, truly. It's one thing to see a pattern. It's another to know the underlying company is robust enough to follow through. But what about all the external noise? Geopolitical events, shifts in market sentiment, broader economic tremors? How does the report factor these external influences into its overall assessment for Royal Gold. No company operates in a vacuum after all, and gold in particular is often seen as sensitive to global events.
Indeed, no company exists in isolation, and this is where the report's nuanced perspective really shines. If we connect this to the bigger picture, the report is very pragmatic in acknowledging external factors that could influence gold prices and, by extension, Royal Gold, given its business model.
Okay.
However, it doesn't just list these factors. It interprets them within the context of the stock's intrinsic rhythm, providing a unique lens.
Interprets them.
How so?
Well, the report specifically mentions geopolitical volatility, citing Trump's 2-week deadline on Iran as a recent example. Such events could, in theory, send shockwaves through global markets and typically drive demand for safe haven assets like gold.
Right. Usually gold goes up on that kind of news. Usually. However, what's particularly insightful is how the report interprets the market's reaction to this specific event. Markets interpreted the move as delayed military action.
Delayed, not immediate conflict.
Exactly. This suggests that the immediate panic or the expectation of an escalating full-blown conflict was somewhat muted or even seen as a temporary reprieve. This likely led to a less dramatic initial impact on gold prices than a direct confrontation might have caused. This nuanced interpretation is key to understanding why the report doesn't see it as a fundamental threat to Royal Gold's rhythm.
Okay, so context matters, not just the headline.
Absolutely. There's also mention of easing gold demand concerns and a minor gold price dip driven by short-term profit-taking. For those of you who follow gold, you know its price can fluctuate significantly.
Oh, yeah.
This tells us that any recent dips in the price of gold itself are largely seen as temporary corrections, primarily due to traders cashing in on recent gains after a run-up, rather than a fundamental shift in global gold demand or a long-term bearish outlook for the metal itself.
So just profit-taking, not a change in the trend for gold.
That's the interpretation here. This distinction is crucial because Royal Gold's revenue and performance are intrinsically linked to the price of gold. If the underlying commodity is only experiencing minor temporary pullbacks due to profit-taking, it bodes very well for the company's revenue streams and profit margins moving forward, supporting the bullish outlook.
Right, because their model depends on that gold price staying relatively strong.
Precisely. And the report's conclusion on macro risk is a powerful takeaway and truly critical for understanding its overall investment thesis. It states that macro risk still exists, but serves as a timing cue more than a trend reversal.
Okay, break that down. A timing cue, not a trend reversal.
This is a profound insight. It means that while external events, geopolitical flare-ups, economic news might indeed create short-term volatility, perhaps causing minor price fluctuations or offering more attractive lower entry points, they are not expected to derail the overall bullish rhythm identified for Royal Gold.
So the rhythm is stronger than the noise.
That's the thesis. Instead, these macro events are seen as valuable opportunities for discerning traders and investors to time their entries more strategically, perhaps getting in at a slightly better price point during a temporary dip caused by the noise, rather than signals to abandon the fundamental and technical outlook altogether.
So use the volatility generated by news as an entry opportunity if you believe the rhythm holds.
That's exactly the implication. It emphasizes the remarkable resilience, according to this analysis, of the identified rhythm against broader market noise, positioning these external factors as opportunities to fine-tune entry, not to abandon the overall thesis.
Okay, that's a really interesting perspective on risk. So tying all these incredibly diverse threads together, the intricate VAR rhythm analysis, Royal Gold's demonstrably robust financial strength, and this nuanced interpretation of the external environment. What's the overall forecast for Royal Gold according to this deep dive? For someone watching this stock, what's the bottom line, the ultimate summation of all these insights?
You've encapsulated it perfectly. What's truly compelling here is how the report synthesizes the convergence of all these signals into a clear, concise, and high-conviction outlook. The core forecast, the very heartbeat of the entire analysis, is that converging MACD plus rhythm recovery equals multi-time frames set up for expansion.
That's the formula.
That's the core takeaway equation, yes. It's the culmination of everything we've meticulously discussed. The trap breakdown having cleared the path, the MACD signaling that coiled spring, and the price having successfully returned to its natural rhythm band. This powerful alignment across all relevant timeframes sets the stage for a significant upward move. It's the market, according to this analysis, taking a deep breath before a big leap.
A big leap. Okay. Are there specific levels to watch for confirmation?
Yes, the report emphasizes key thresholds that act as critical confirmation or alert levels for investors. It explicitly states that holding above $176 maintains bullish structure.
$176. That's a key support line then.
It sets a critical support level for you, the investor, to watch very closely. As long as Royal Gold's price remains above this specific point, the bullish outlook derived from the VAR rhythm analysis remains firmly intact. It provides a clear line in the sand.
And if it breaks below $176?
Well, should the price fall decisively below that level, it would, of course, prompt a necessary reevaluation of the bullish thesis presented here.
Makes sense. What about on the upside?
Furthermore, the report notes that upside risk increases beyond $190, indicating a significant breakout point.
Upside risk increases. You mean upside potential.
Ah, good catch. Yes, essentially upside potential, or perhaps the probability of a faster move higher, increases. What this means is that once the stock not only reaches but surpasses this $190 level, the probability of further rapid price expansion dramatically increases, according to the report.
So $190 is like an accelerator pedal.
It suggests a clear signal for accelerated momentum and significantly reduced resistance to higher prices. This gives a very clear roadmap for what to expect and, crucially, what price points to watch for confirmation or potential shifts in the outlook.
That's a remarkably precise forecast, providing not just a direction, but also key milestones to watch along the way. Very useful. And beyond this core analysis and forecast, the report provides some additional, what it calls advanced metrics. These aren't necessarily core to the rhythm analysis itself, but they offer like extra layers of confirmation, almost independent checks that add even more confidence to this positive outlook for Royal Gold.
That's a good way to think about it.
It's like getting a second, third, and fourth opinion, and they all seem to be aligning perfectly.
Exactly. These advanced metrics provide external validation, almost like independent checks from different analytical perspectives, that strongly reinforce the technical rhythm analysis and fundamental strength we've already explored. They add another layer of objective confidence to the identified rhythm and potential expansion.
Okay, what are these advanced metrics?
All right, first, on institutional flow, the report mentions 3-week net buying from institutional players.
Institutional buying, the big money.
This is incredibly significant because large institutional money flows, we're talking hedge funds, mutual funds, large pension funds, can often precede major price movements in the market. They have extensive research capabilities and significant capital.
Right, the smart money.
Their sustained net buying, especially over a period of weeks, suggests they are quietly accumulating shares because their own rigorous research, perhaps totally independent of this rhythm analysis, has also indicated a compelling opportunity. This provides a powerful tailwind for the stock price, signaling that big players believe in this underlying story.
Like seeing the big ships moving into position before the fleet sails.
Exactly. It's a strong positive sign. Next, we look at short interest. The report notes this as 2.4% below average.
Short interest as people betting against the stock, right?
Precisely. Short interest represents the total number of shares sold short by investors hoping the price will fall, but who haven't yet covered or closed their positions. When short interest is below average, as it is here, it indicates that fewer traders are betting against the stock.
And why is that good?
It's a positive signal for two main reasons. Firstly, it reduces potential selling pressure that could come from short covering later. If the price rises, you don't have as many shorts needing to buy back shares. Secondly, it simply means there's less bearish sentiment, less skepticism, and fewer positions that might create overhead supply and resistance to upward moves.
So fewer people fighting the potential uptrend.
Essentially, yes. Lower short interest means less skepticism and less potential selling pressure. The report also highlights community sentiment as rising.
Community sentiment, like retail investors.
This refers to the broader retail interest and confidence in the stock, often observed through trends on social media platforms, online investor forums, general investor chatter. While it's not a standalone predictive indicator on its own, rising community sentiment can absolutely fuel demand and create a powerful self-reinforcing buying pattern as more individual investors become interested in and confident about the stock's prospects. It represents collective enthusiasm and can add to buying pressure.
The power of the crowd sometimes.
It can be a factor, and perhaps most intriguing and a testament to the modern analytical tools available in finance today, is the AI signal model.
Ooh, AI. What does the AI say?
The report states that this model, leveraging advanced algorithms, shows a 71% probability of upward continuation.
71% from the AI model, too. That aligns with the other probabilities.
It's a powerful technological validation of the human-driven rhythm analysis we've been discussing. It means that an artificial intelligence, likely trained on vast amounts of historical market data and complex patterns, has independently corroborated the bullish outlook identified by the VAR rhythm methodology.
Wow, so the machine agrees with the human analysis.
It adds another layer of objective, data-driven confidence to the forecast. This confluence of traditional, sophisticated technical analysis, robust fundamental strength, positive market sentiment from institutions and the community, and cutting-edge AI validation, well, it creates a very compelling and multifaceted picture for Royal Gold.
A truly holistic view, like you said.
Yeah.
We've taken a truly comprehensive deep dive today into Royal Gold, exploring how this unique VAR rhythm analysis methodology, this idea of finding the market's hidden pulse, combined with Royal Gold's robust financial health and a nuanced understanding of the broader macro context, can paint such an incredibly detailed and, frankly, surprisingly precise picture of a stock's potential trajectory.
It's a fascinating synthesis of different approaches.
It really is. We've seen how Royal Gold is showing synchronized signals across multiple time frames, monthly, weekly, daily, even the 120-minute charts, all converging and suggesting it's in that pre-expansion accumulation zone, poised, it seems, for its next leg up, according to this source.
The setup looks quite defined in the report.
It's a powerful reminder, I think, that sometimes the most profound insights come not from simply reacting to daily headlines, but from looking beyond the surface, recognizing these underlying repeatable patterns, and diligently synthesizing information from multiple angles, just as this proprietary report has done for us.
Digging deeper.
It's about listening to the quiet, persistent rhythm beneath the noise.
Well said. And this deep dive into Royal Gold's rhythm recovery truly highlights a compelling idea that markets, despite their apparent chaos and unpredictability, often move to discernible patterns and underlying rhythms that, once identified, can offer significant clarity. This raises an important question, I think, for all of us, for you listening. How often do we overlook these subtle, repeating rhythms in other areas of our lives simply because we aren't equipped with the right tools or perspectives to perceive them?
That's a really interesting thought. Rhythms beyond the market.
Think about the cycles in business, the ebb and flow of projects, maybe even the patterns in personal productivity or creativity. Consider how applying a structured, multi-layered analytical approach, much like the VAR rhythm analysis methodology we've explored today, might unlock unexpected insights not just in finance, but in any complex system you encounter.
Applying this kind of thinking elsewhere.
It might allow you to anticipate change and act with greater intention. There are rhythms everywhere. The challenge and maybe the opportunity is in learning to listen for them.